Welcome to Supercharge Your Business with Specialized Trusts. What Bill Gates hides in plain sight. I'm your instructor, Scott Patton. I'm going to be taking you on an amazing journey. I hope you enjoy it as much as I enjoy bringing it to you. All right. So we're going to start with around 2003, 2004, Microsoft wrote dividend checks, and Bill Gates' check was for $3 billion based on the stock that he owned in Microsoft. Now, in 2000, he got together with his lawyers and he set up the Bill and Melinda Gates Foundation and the Bill and Melinda Gates Foundation Trust. And you can notice how close they are in name. One spends money and the other manages the assets. And so, of course, Bill in the 1990s could see quite clearly that Microsoft was just accumulating cash at a huge rate, and that sooner or later, the stockholders and the government are going to say, you've got more money than anybody else on the planet. Microsoft, you have to start divvying it out or buying things. And I guess there was nothing that they felt they could buy at that time. So his foundation started off with, and so what did he do to pay this zero tax? Well, he pledged all of the dividend check to the Bill and Melinda Gates Foundation Trust. And so with that $3 billion 20 years ago, it's now grown to over $55 billion. And of course, Warren Buffett has donated a significant amount of money to that. And a few other people probably have as well. And they've put out a lot. I mean, they have spent an awful lot of money on things that are important to the foundation. And it's still 20 times, almost 20 times itself. Okay. So, and of course, when he did this, being the wonderful, open, easily accessible person that he is, he wrote the Bill Gates official course on exponential wealth growth without taxation. And it's been a bestseller for those last 20 years as millions of Americans use his strategies to mitigate, defer, and outright eliminate taxes on their income. You've never heard of that course because he never made that course. And he's not about to tell anybody outside his inner circle, people like Elon Musk and Richard Branson and Warren Buffett. And of course, some of them probably had found out from the people that taught Bill how to do this. This is something you only hear about from billionaires doing. I mean, you don't hear about it from billionaires, but if you watch what they do, it's pretty obvious that this is what they do. And recently, Elon Musk had a fight with Ms. Pelosi in the Congress about taxes, and he bragged that he was going to be giving the government the biggest income tax check they'd ever had. And of course, the time for that check to have been paid and sent to the government has come and gone, and there's been no discussion of it. It's been kind of lost. And the reason for it is because he's never going to pay very much tax on the sale of his shares in Tesla that he made a fortune on, because this is all bound up in different trusts and foundations. And that's what they do. They use the trusts and the foundations, private family foundations, charitable trusts, and charitable trusts to mitigate, defer, and sometimes totally eliminate taxes. So if you go and you look for any information on Elon Musk and you do see that, oh, here it is, he's paid that, he's handing that bill. I mean, you just know that it would be front page news because he's in the news all the time, and he would have taken that check down to the IRS, personally handed it to somebody, and that would be that. But that's not what's happened. And it's because he's got it all wrapped up in trusts and foundations as well. And of course, the government is always talking about, we need to do, raise more taxes and do all the rest of it. Why aren't they closing these, we'll just call them loopholes? And one reason is I don't think they can. And the second reason is pretty much every congressman and congresswoman and senator have these types of trusts and foundations in place so that when they get money that they're not supposed to get, nobody knows about it. I don't know if I can say that or not. But when you look at, the number of congressmen and senators that have gone from a modest millionaire status to multimillionaire status in the time that they have served the public, how do you do that making $174,000 a year, which is basic wage that they make, right? You can't. Not going to happen. So there are other things at play, other things that they're doing, and it's all tied up in specialized trusts and foundations. And these trusts are able to mitigate taxes on income. Mitigate being defer or, in fact, eliminate those taxes. And that's what we're going to be talking about in this course. So the next thing I want to this is one of the most important things that you need to get your head around. And most people have a terrible time with this because we've been taught the opposite. The secret to success is to own nothing but control everything. Nelson Rockefeller said that. Okay, so what that means is you can drive the car, but if the police pull you over for speeding and you hand the registration, it's not your name on it. It's some other name on it, and usually a trust name on it. Trust can own anything that a human being can own. So we've been taught, you need to have that hot car, go buy it. You need to have a really nice house, go buy it. You have to have a 50-inch screen, TV screen, go buy it. Well, what would happen if the trust bought it instead of you? And then it was owned by the trust, but you had access to it. You had the ability to use it whenever you wanted to. And that is what we're talking about, is the use of things, but not the ownership. Because if it's owned by you, someone can take it away. You get sued. It goes to the courts. There's a piece of paper that someone brings to the door and says, hey, Scott, this house you live in, it's now mine. And I go, oh, well, this is not my house. What? Yeah, it's not my house. So they can't take it away, right? Like if I was living in Sue's house and she just let me live there, right? They come and what are they going to do? Take my shirts? No. So that's the whole key to the trust, is that you do not own anything. The trust owns everything, and you need to get that mindset in place of, I don't own this car, I don't own this house, but I get to live here, and that's pretty nice, right? So the secret to success is to own nothing but control everything. I want you to just write that down and tattoo it on the inside of your eyelid, because that is the key to this whole process. All right, so now the other thing that we want to talk about here is hundreds and hundreds of flavors of ice cream. How can you decide which one is the one you like? Which one is the best one to have? And it's the same with trusts. There are many, many different types of trusts. Trusts were far more, first of all, trusts have been around for 2,000 years. They are based on common law, and they've been used in England and other common law countries for a long, long time. In the 1800s, there were oil barons and railroad barons and everything else. They used everything as a trust, and they abused it. And so it got a bad name, and now people don't talk about it. And it's continued to have the bad name, but it's still around, still being used the same way it always was, but they don't talk about it, right? They don't say, oh, this is a trust. So there are living trusts. There are living wills that are trusts. Your IRA and your 401k are all trusts. If you have a self-directed IRA, you use a company called Quest Trust. They're a trust. What does that mean? It means that you trust them with your IRA to do the right things. And of course, it's self-directed, so they will do what you tell them to do with the stuff that's in your trust. And some of these trusts, you've paid the tax before, but it'll grow tax-free, right? So, I mean, there's a big difference between paying the tax on your income and then taking some of that income and investing it into something, whether it pays interest or capital gains or dividends, you're going to pay more tax, right? So you paid tax, you're going to pay more tax. Some things like the 401k grow tax-free. You pay tax and then it grows tax-free, and I'm not sure what happens after that. But these are all trusts. And the reason it can grow tax-free is because it's in a trust, okay? Now, those are simple trusts that everybody knows about and uses and talks about. But when it comes to business, oh, no. We don't use business trusts. So we don't do our business in a trust. It's an LLC. It's a C Corp. It's an S Corp. It's something else. And so, we have hundreds of flavors of ice cream. There are hundreds of different types of trusts. And this is the thing, right? Like if you go and say, hey, I just saw this great course on trusts and everything else, I want to do it, and you go to your CPA, he might know about like living trusts, or he might know about being in the IRA, that type of trust, and he's going to say, well, you can't do that, right? Because he hasn't looked into it. He doesn't want to look into it. He has his whole way of doing things, and he's not willing to change. You may not be willing to change either. Your mindset, the way you do your business and everything else, it does change when you work out of a trust instead of an LLC or a C Corp. However, I just want you to know that when you go to your lawyer, you go to your CPA, and they say, oh, no, it'll never work. They don't know what they're talking about. They know about the trusts that they know about, and those don't work. But they don't know about this trust, right? So you're really going to have to do your due diligence, check it out, get into it in more detail, and see what it's about. Basically, trust lawyers will tell you what you're learning today may not work. It's because they only know vanilla ice cream. They don't know another flavor that's totally different, okay? And we're not talking about a living trust or a land trust or the types of trusts you can find templates for at the bookstore. We're talking about trusts that have protected Bill Gates from paying dividend taxes on $3 billion dividend checks. And, and it's pretty cool. And, this is something that it's a secret. Like nobody wants to talk about this stuff. And the reason why is, can you imagine if all the businesses in all the small businesses, right? Like when you delve into this more, you understand that like Walmart, they have trusts and foundations. Home Depot has trusts and foundations. IBM has trusts and foundations. Apple has trusts and foundations. You have to kind of look deep to sort of find them and dig a little bit, but they're all there. And your congressmen and senators, they all have these sort of things too. And they don't all have the same thing, but they kind of all play the same game. So when I'm talking about a specialized trust that does this amazing thing, well, actually, there are four flavors of ice cream, if I can use the ice cream analogy, okay? Flavor number one, mitigates or defers taxes. And in our case, it mitigates or defers or eliminates taxes for generations. So for example, your IRA, it might defer taxes until you die or until you pull it out or whatever. And then you have to pay tax on it. But with these, it can be generation after generation after generation. So you need to be thinking further ahead than tomorrow, which is what most of us do, right? Like, I got food for today, I'm good. Yeah, but what about your kids? What about your great-grandkids? What about your great-great-great-grandkids, all right? How about making sure they live a good life? Okay, so we have this deferred tax flavor of ice cream. The second one we have is privacy. The trust gives you amazing privacy. And an example of that is Bill and Melinda Gates have a trust that's not the Bill and Melinda Gates Foundation Trust. It's got another name. And they used that trust. Well, they didn't use that trust. The trust decided that one of its beneficiaries, their son, because he was going to go to school in Chicago, he should have a home in Chicago to live in, which is reasonable. So the trust bought a house in Chicago. The son lived in the house rent-free because he's a beneficiary of the trust for, I guess, 4 years. And when he was done his education, the trust sold the house. And the selling of the house made the news, all right? Who knew that he was there? No one. I mean, the deed, if you went to the land people and said, okay, where's Bill and Melinda Gates' house that they bought in Chicago? There's going to be nothing that says Bill and Melinda Gates. And it makes sense. I mean, their son is going to be in Chicago going to school. They're not in Chicago. He's in a house. Do you want everybody to know what house he's in? Of course not, right? So this privacy was very, very important. And for us, it's very, very important because it's one aspect of asset protection, right? If the son had done something, just to continue on with this example, if the son had done something and been sued, and then and he was an ordinary person, not the son of Bill and Melinda Gates, right? The first thing the lawyer is going to do is say, okay, well, like, what's this person got? They'll check the land. They'll check, what houses he's got. They're going to see he has no houses. They're going to see he has no money in his bank account. They're going to see he has no car. He may be driving a car, but it's not his car. He may be living in a house. It's not his house. He may be accessing money from a bank account, but it's not his bank account because he's the beneficiary and he has access, but not ownership, right? And so they're going to say, there's no point because this guy's got nothing. And then they go away, right? Now, it may be that, that's the bad side of this is you could use this for nefarious purposes. You could do something really bad to somebody and then, I can't, sure, I owe you $100,000, but I own nothing. And that's not what this is about. This is not about being dishonest or unethical or anything along those lines, because what can happen is the person could be sitting on your door every morning when you leave to go to school and say, where's my money? Right. So, but instead of getting some outrageous settlement, like one guy was like $1 billion or some crazy thing, recently in the news, it's going to be, what is a reasonable thing? Okay, I hit you, I spilt your coffee in your lap, I destroyed your shirt and your pants, and you got a little scalding. What was the doctor's bill? What was this? What was that? Pay for all of that. Give them a little bit extra for their time, and you're done, right? And being fair. So, second ice cream is privacy. Third ice cream is asset protection. Talked about that a little bit more. The trustee is the person that writes all the checks, buys everything for the trust in the name of the trust. And if someone is sued and they're in the trust, and the person that is harmed goes to the trustee and says, write me a check for $100,000, they're going to say, no, I can't. Why? Because the contract that I have as trustee with the trust says the only people I can give money to is the beneficiaries. So you're not a beneficiary, I can't give you any money. Sorry. End of story, right? It's a contract. I can't break the contract because I would be liable. So the trust then is pretty well protected in many, many ways from frivolous lawsuits and people trying to take away your stuff. And the fourth thing is legacy. The trust lasts 21 years and then can be renewed every 21 years. So you've got children coming, you renew it this 21 years, the next one, 200 years go by, your trust is still going, everything is still being deferred, and it will be deferred until 20 years after your last beneficiary passes away. So at that point, who cares, right? And so the legacy, this is something that really can have a huge impact on your children. And of course, we're talking about a lot of money and your grandchildren and your great-grandchildren. So we have put in place in these trusts protections so that if someone becomes a trustee that's like the wicked godmother of Cinderella, they can be removed and that sort of thing, so that it's fair for everybody. So we have different types of trusts. There's hundreds of different flavors and combinations that you could have, more being designed all the time. We have a very special trust set up, and I'm going to explain what it is to you right now. The trust that we're talking about that's going to help you in your business is a complex trust. It's a non-self-settled trust. It's a discretionary trust. It's a spendthrift trust. It's a dynasty trust. It's a non-grantor trust. It's an irrevocable trust. And it's a 643 compliant trust. All right. So what does all that mean? Well, like I said, there's lots of different flavors of ice cream. So if there's a complex trust, there must be a simple trust. Simple trusts are far more restrictive. Complex trusts are very flexible. And we often say that the major advantage of our trust is their flexibility, and that the major drawback of the trust is their flexibility. So you end up having a lot of decisions that you have to make on how you want to set up your trust and what you want it to do. And oftentimes it's like, well, just tell me. Well, I can't tell you because I don't know you the way that you know you and how you want to work this. Self-settled trusts are those which the creator of the trust is also a beneficiary. The grantor or settler of your trust, of our trust. So our self-settled trusts are those which the creator of the trust is also a beneficiary. In other words, the grantor or settler of the trust is also a beneficiary. So, the government looks at that and says, well, it's still yours. It's not really not yours, so we're going to tax you on it. But in our trust, the grantor or settler disappears forever. They have no claim ever on the assets of the trust. Okay, so usually a self-settled trust becomes a non-settled trust when the trustee passes away, or the grantor of the trust or the settler of the trust passes away. But in our case, we have a person that sets up the trust, and then they go away. They have no claim to that trust. And once you separate the creation of the trust from the beneficiaries of the trust in a way that can never be repaired, then a non-self-settled trust has a lot of tax advantages. Discretionary. Okay, a non-discretionary trust provides that the trustees must pay trust income upon request to the beneficiaries. In other words, they are not in a position where they can refuse. With a discretionary trust, the trustees have the option whether to make payments to the beneficiaries or not. So I've been a bad boy this year. The trustee is mad at me. I want some money for a trip to Mexico. No, not doing it. You're on your own. And I have nothing to say about it, right? So that, again, when the beneficiaries have no power in the trust, and they are the ones that receive the benefits of the trust, whether it's cash or a house or a car, the government says, well, that's deferrable income. Spendthrift. A spendthrift trust is a trust designed so the beneficiary is unable to sell or give away his or her equitable interest in the trust property. Very, very similar to the discretionary trust, right? Where a non-discretionary trust, right? Where the beneficiary could ask for the money and they could not be refused. So a spendthrift trust is a trust designed so the beneficiary is unable to sell or give away her equitable interest in the trust property. They have no power. The trustee is in control of managing the property. Thus, the beneficiary of the trust is not in control of the property, and her creditors or his creditors cannot reach those assets because of that. Huge asset protection feature of our trust, because the trustee is under contract to the trust to only distribute money or assets to beneficiaries. So if the beneficiary is sued and loses, the complainant cannot receive funds from the trust. Now, you do not want the complainant, as I said before, sitting on your porch every morning asking for money. So you need to, be ethical and come up with some sort of reasonable and fair settlement. Dynasty. Okay, a dynasty trust is a long-term trust created to pass wealth from one generation to the other without incurring transfer taxes, such as estate and gift taxes. And one day soon, I'm pretty sure we're going to have an inheritance tax. So all of those taxes will be mitigated or deferred or of non-issue with the dynasty trust. Now we have grantor or non-grantor trusts. A non-grantor trust pays income tax at the trust level on any taxable income retained by the trust. If a trust makes a distribution to a beneficiary, so in other words, I say to the trustee, hey, I'd like to have $10,000. They write me a check for $10,000. I deposit it in my bank. That is taxable income. So, they just go through as ordinary taxable income to the beneficiary. And it's taxed at the beneficiary's personal income tax return, okay? In our trust, the grantor is gone forever, so a non-grantor trust pays income tax at the trust level. And we want that because there are things in our trust that allow us to mitigate or defer, and we'll get into the passive and active income aspects of that in a minute. Irrevocable. Just a second, let me just do this. irrevocable. An irrevocable trust is a trust that the grantor cannot change or revoke. And that's what ours is. And the grantor actually signs a contract giving up all rights to any claim on the trust whatsoever in perpetuity forever and ever. Now, a 643 compliant trust, this is the highest level of access asset protection. It eliminates probate, gift, and estate taxes, and the potential to donate 100% of trust active income to nonprofits, including private family foundations, are there. And it has what I call Secret Service level privacy. And finally, tax mitigation in a 643 compliant trust is such that it can defer capital gains and passive income in perpetuity as long as the trust is active and continuing to work. And of course, 643 is the number of the tax code in our tax system, and has only seen very slight modifications since 1910 when it was written. Most senators and congresspeople, along with executive branch personnel, have 643 compliant trusts as disclosed on their K-1 tax returns. So the politicians aren't going to slit their wrists. They're not going to stop a good thing that's a good thing for them that nobody else seems to know about except high-end large corporations. So this is not going to change anytime soon. So business trusts, they're not the trust that your CPA would recommend. There's a good chance your CPA and your lawyer have no idea what I'm talking about here. Although they may know, oh yeah, I know what a complex trust is, or a discretionary trust, or whatever. They've heard it, but it's kind of like the doctors who get 5 hours of nutrition training and 10 years of medical school. Lawyers and CPAs get about 10 minutes of trust training in their 3 or 4 or 5 years of accounting training and law training. All right, so let's move on. Now I want to talk a bit about active versus passive income, because in the trust, passive income can be deferred. And so first of all, like, what is it? All right, active income is, it's like when you go to the store and you buy a chocolate bar. That is active income to the grocery store, right? You go in once, you buy some food, you pay, that's active, right? You call a plumber, he comes and fixes your pipe, you pay him $100 for the plumber, that's active income. Passive income is income from the sale of books, courses, subscriptions. So if you wrote a book, you put it up on Amazon, and every couple of days you sell the book, and Amazon sends you 10 cents or $100 or whatever it is, then that's passive income, right? If you have a subscription service, so if you're a gym and you have a membership, right, and the person's paying $47 a week or a month or a year or whatever it is for gym membership, that's passive income, all right? Other passive incomes is I buy a house and I rent the house to Susie. Susie pays me $1,000 a month. That's considered passive income. Licenses. I've got this amazing idea. I've patented the idea, and then I've licensed the idea and everything else to Walmart. Walmart makes this thing and sells it on their shelf. It's active income from Walmart every time someone buys it, but every month when they send me my licensing fee, that's passive income. And for musicians, right? A lot of the musical distributors like Sony Music, they pay a royalty. Well, that royalty to the musician is passive income, right? The guy wrote the song, he sang the song, the record went out in 1960, and people are still listening to it on the radio, and people are still buying it, and they're still listening to it on Amazon Music, and the Sony Music tabulates all that stuff and sends a guy a check for $10,000. Passive income. I take my my savings, I put it into a bank. That interest is passive income. I take my savings, I buy a mutual fund, and they pay me 8% interest a year or whatever, passive income. All right. So big difference between active and passive income. Capital gains, I buy a house for 100,000, I sell it for 150, I made $50,000 capital gains. That's not really passive income, but it's in the it can be deferred area. Okay. So in law, everything is defined. That includes what income is and is not. When money can be income and when it can be something else. Okay. So this is the part where we run into problems with words, right? Because we are so used to income. But actually, if you read the Income Tax Act, they define income. Like there's taxable income. And if it's not taxable income, then it's non-taxable income, I guess. And so when I'm talking about this, I'm going to use the same word, and I'm going to be meaning one of them is taxable and one of them is not taxable. And you're just going to have to try and grasp this as I go through, because we don't have another word to use, right? The Eskimos have 50 words for snow because they're in snow all the time. And there's all sorts of different types of snow. But those of us that aren't in the far north or Antarctica, we just sort of see snow, and we have snow, we have rain, we have sleet. That's all that falls out of the ground, out of the sky, I mean. But the Eskimos have a lot of different words for snow. And unfortunately, we're limited. All right. So trusts can mitigate passive and capital gains incomes. The assets in a trust are part of the body or corpus of the trust. All right. So I have a house. It's owned by the trust. It's part of the body of the trust. It's part of the corpus of the trust. So these are words that we don't use them this way, but you need to get familiar with using them this way in order to understand, because like every industry has its own language, and this is no different. So you're going to have to learn the language. Principal is defined as property held in the trust. Okay. So the principal property. So I'm going to tell you to write it down, principal, because principal is one of those words that is never used this way. We don't think of it this way. And if you don't understand that there's a principle, not a principal, like, we have principles for living and that sort of thing, and not principal of a school, but principal as property held in the trust. Okay. Now, income is defined as money or property the trustee receives as a return from a principal asset. Okay. So principal is the house that I have in the trust. And actually, let's not use the house as an example here. Let's use the mutual fund. Now, with a mutual fund, it pays 8%. Okay. The mutual fund, let's say it's $100,000, is property held in the trust. It's the principal of the trust. Now, income is defined as money or property that the trustee receives as a return from a principal asset. So that 8% could be defined as income. So the IRS handbook on estate division auditors has an interesting sentence in it. The allocating receipts and disbursements, so the money that comes in, the money that goes out, to or between principal and income. So in allocating receipts and disbursements between principal and income, or to principal or to income, or between principal and income, Section 103 sets forth the following hierarchy of rules. Okay. So number one, allocate according to the terms of the trust. So in other words, if there's something written in the trust, so I'm receiving, right, money, and I have to go and allocate that between the principal, which is the corpus, the body, the trust of the trust, I was going to say the mutual fund in the trust, or income. Okay, so in allocating receipts and allocating money coming in between the principal and the income, the Act says, number one, allocate according to the terms of the trust. So what if the trust said all receipts from the mutual fund are allocated to principal? Oh, but I think of that as income. Yeah, you do. But what if you said it wasn't? You just said it was principal because your trust says so. That's the number one rule. That's the first rule. The second rule is allocate according to the provisions of the Act. In other words, what's written in the trust takes precedent over what's written in the Act, because the Act says if you have a mutual fund and it gets you 8%, that 8% is taxable income. But if your trust says something different, it takes precedent. It's number one, and number two is the is the Act. And number three is according to principle, which you can argue all of these because that's what lawyers do, but it's like if it's not in the Act and it's not in the trust, then it goes to the principal and it's not income, right? So in other words, if the trust rules don't cover it and the Act doesn't cover it, it's not allocated to income for taxation, but to principal and not taxed because it's the body and the corpus and it's not taxed. So let's go back to number one. If the trust rules state money that might be considered income, if it is coming to an individual, is instead allocated to principal, then it would not be taxed in the trust. And remember, all the taxation occurs in the trust, in our trust. Simple trust, it's whoever the beneficiary is that pays the taxes, whether they get the money or not. So beneficiaries who receive cash or disbursement from the trust have earned taxable income that they have to report on income tax returns, because now it's outside the trust, right? So let's move forward to the uniform principle. Yeah, there's that word again, right? It's not principle as in the principal of the school. It's principle in terms of the body or corpus of your trust and the Income Tax Act. So income from capital gains, stocks, real estate, crypto, passive income, rental, lease, intellectual property, patents, royalty, software, books, subscription is corpus, is part of the body of the trust, not income. So there's the government itself saying this stuff is not income. Income, or should we say money coming in? This is where I had problems stating, what other word do you use but incoming money, right? Money coming in, income. So income derived from assets in corpus is corpus, not taxable income. Income derived from assets. So money that I got from my mutual fund in my trust, well, not my trust, in the trust, is the trust. It's the same amount. It's part of that same amount that started. So even though it went up by 8%, that's not taxable income. That is part of the trust. We don't even have words to describe it properly, sounding kind of crazy, right? So what I had written before was income, or should we say money coming in, derived from assets in corpus is corpus, not taxable income. This money or income is reported on a 1041 tax return where it is added, then deducted as an extraordinary dividend. Okay, so earlier we stated the rules of the trust are the primary rules. If it does not cover there, then you go to the Act. The decisions of the trustee is the factor which defers or mitigates the taxation. Okay, so the trustee decides if the income is taxable income and taxed, or if the income is corpus and not income to be taxed in the trust. So you're the trustee, you just got a dividend check for $100,000. and your state and your federal tax people are going to want 50% of that if you declare it income, and they have no claim on it if you declare it as corpus or body of the trust. What you going to do? Pretty obvious, right? So active income, I go to the store, I buy something to the store, that's active income. Passive income is I buy a subscription to a newsletter that I like. That person who's receiving the money every month, it's passive income. And when it's passive income or capital gains, the way the laws are written and the rules are written and the way the trusts are written can mitigate or defer those taxes. All right. Now, trusts can pay for everything except. And so a trust can buy anything a person can buy, right? Except fun, food, and fashion. All right. It could pay for it anyway, but it would be taxable income to the beneficiary, right? So a trust can buy a house. I can live in the house. I'm a beneficiary of the trust. I don't pay a penny. There's a leak in the roof. The trust gets the roofer to come and fix it. It needs painting. The trust gets someone to come in and paint it. It needs new beds. Trust buys the beds. It needs new fridge. Trust buys the fridge. The lawn is long. Trust pays for the landscaper to come in. Okay, it can buy a car, and it can buy the gas, it can buy the oil change, it can buy new tires, do all that stuff. So it can pay for everything that the beneficiaries could want, except for food, fun, and fashion. Now, there is a caveat to this. If the beneficiaries are under 21, it can buy the beneficiaries food and it can buy them clothes. 21 is kind of an important age. If you're a beneficiary and you want to go to university for 4 years, but you're 60, but you're the beneficiary, the trust can pay for it. And then the trust would not just pay for your tuition, it would pay for your books, it would pay for your transportation to Hawaii, where you want to take the course, or you want to take the university courses. It would pay for your accommodation and your food while you were there. It would pay for everything while you were going on. So if you had a weekend conference you wanted to go to that was educational, the trust could pay for your flight there, your hotel, your meals, the tuition, anything that you just wanted to buy from there that you felt would be good. Doesn't matter how old you are. All right. Education is one of the things that the age doesn't matter. But the food and the fashion ends. There's no fun. It's just the way it is. Having said that, when it comes to the amount of taxes that just think about it for a second. If you don't have to pay for your accommodation and you don't have to pay for your transportation, and there's a bunch of other things you don't have to pay for, and how much are you spending on clothes, and how much are you spending? Within reason, you don't want to have $1,000 shirt necessarily. Your expenses are going to be pretty low. You get a $26,000 exemption, I believe, in the United States on your first $26,000. So you can pull $26,000 out and spend that. So it's like $2,000 a month before you have to pay any taxes. If you don't want to pay any taxes, the taxes on $30,000 are pretty insignificant. Okay. So trusts can pay for everything except food, fun, and fashion. So swimming against the tide, if everyone does it this way, and with this way being getting an LLC or a C Corp or an S Corp, how can you be sure the trusts work? Well, the first way we can be sure is Bill Gates. He's showing us over and over and over again, if we watch, that trusts work. And he's paying minimal income tax, I would suggest. And he's not the first person to figure it out. The oldest trust in America was set up in the 1700s, and these trusts have been used for centuries before that as a way for the kings and queens to hold on to their wealth. All right. But as you can imagine, the government and the IRS don't want you to know that you could set things up and mitigate and defer taxes. So that's why nobody knows about it. So one of the questions I want to, basically before you go any further, you should ask this question. If your taxes were over $50,000 last year, would you invest an hour or so to see if you could mitigate them in some way, right? And of course, one of the things is that is very difficult to really do a lot of mitigation or deferring of taxes is W-2 income. You're the president of a company, they pay $500,000 a year, you're going to be paying your taxes on that, right? This is for people that have businesses that we can set up in business trusts, and we can take some of that income as passive income, and some of the active income we convert to passive income and drop that, we mitigate a lot of those taxes, all right? But if you're not, maybe, if you're 30 or 40,000, it's worth looking into. But for a number of people, it's not the case, right? The guy that works at McDonald's as a manager gets W-2 income, he has nothing saved, and he's renting. This is not, for you, right? If you're a real estate investor and that's your business, a 1031 exchange is what you would typically be using to defer your taxes. The problem with it is that it ends one day when you finally say, man, I just don't want to do this anymore. I just want to get out. And when you get out, you have a massive tax bill, right? So if you were to use a trust instead, a business trust instead, you would be deferring and mitigating all those taxes that you're deferring and mitigating in a 1031, except that it would never end. All right. So it's kind of like you can pay the government now or you can pay the government later. And wouldn't it be better if the later was 200 years from now, as opposed to when you have to come up with that money? Another problem. Let me just, hang on a sec. All right, another problem is social pressure. Everyone, so if you're a real estate investor, people say get a land trust. You get privacy, you don't get any tax mitigation, or get an LLC. And, most lawyers don't really know anything about trusts, how to set up trusts the way that we're talking about. And so, when you ask your dad, your best friend, or your CPA lawyer, they're likely to get the same answer, don't do it. But they don't understand what it is that we're talking about here. And we have lots of CPAs and lawyers who are clients who were adamant that no trust could do what we say they're doing. And when they first heard about the trusts, once they dug into it, once they figured it out, once they looked deeper, it was like, oh, wow, yeah, this is amazing. So, and earlier I said, there's a lot of this is about mindset, living a different way, changing how we do things, not owning things, but having access to them or the use of them. And that mindset is really, really important. But, we've been through 12 years of school, 3, 4, 5 years of college. We've had media bombardments. Everybody knows the best way to invest in real estate is to use 1033 exchanges, land trusts, or LLCs. Everyone knows you want to start a business, get an LLC or an S corp. Everybody knows. And because everybody knows, everybody does. And when they do it that way, they get what everybody else gets, which is huge tax bills. And so we're talking about ways of mitigating the taxes and protecting those assets, having the lawyers off your back, and giving you privacy. Nobody needs to know your business. And so we're asking you to not stick to that way that everybody does it. And, and we've never had a reason to question it before today, but now you do. And hopefully you are questioning it and you are thinking about how this works. And I want to share two quick stories with you. One is my avocado story. I love avocados. I take a knife and I slice it lengthwise and I split it in two, and I got one perfect half of an avocado and I got one avocado half with a seed in it. And then I take a spoon and I destroy that half trying to get the seed out. And I have done that for 50 years, okay? I'm at a sushi bar and I'm sitting up at the bar at the sushi bar and I'm watching the sushi chef, and he splits open the avocado the way I do it. And then he takes his knife and he smacks the seed with the knife, twists the knife a little bit, and out pops the avocado, and he has two perfect avocado halves. I jumped out of my seat. He startled and looked at me. I said, "How did you do that?" I don't know if he spoke English or not, but he showed me how that is such a cool, easy way to do it. I've never known that. Nobody ever showed me that. We didn't have avocados when I was growing up. So, there are ways to get the stone out without destroying the avocado. The second story I want to share is what I call the roast beef story. This mom is got a young family, and she's cooking Thanksgiving dinner, and she has this huge pot for the roast, and she cuts off the ends of the roast and sticks them all in the pot. And there's tons of room in this pot. And the husband looks at her and says, like, "Why do you cut the ends of the roast off?" "What do you mean? Why do I cut it off? That's the way it is." He says, "Well, I've never seen it before." "Well, that's the way mom did it, and that's the way I do it. If you don't like it, go somewhere else." So Thanksgiving dinner comes, and mom comes over for Thanksgiving dinner, and they say to mom, we cut the ends off the roast, and we put it in the pan. Why?" "What do you mean, why? We always do it that way." "Yeah, I know, but why do we do it that way?" "I don't know. Grandma always did it that way, and that's the way we do it." And so a little bit later, grandma shows up for Thanksgiving dinner, and they're all sitting around the table at this point, getting ready to eat. And the little daughter says, "Grandma, we cut the ends off the roast beef when we put it in our pan. Why do we do that?" And grandma looks at them all and says, "Why do you do that?" And they look at grandma, "But grandma, you always did that." "Yeah, I always did that because the pot was too small and I couldn't get the roast beef in it. So I had to chop off the ends to make it fit. You got a big roast beef pan. You don't need that." So are you doing everything you're doing because it's always been done that way and that's the way you're taught, not because that's the best way to do it? And that's what we're talking about here. With trust, we found a better way to do it, and we want to show you that. Now, there are three trusts. There's an IP personal trust, so intellectual property personal trust, business trust, and private family foundation, which is a 501c3 foundation. 501c3s, by the way, can be trusts or corporations. If they're corporations, they're very, very limited. The personal trust is usually where we hold the assets. If you've got a company that says owns a factory and makes stuff, you want to put that assets of that factory in your personal trust, and then you lease it to your business trust. And then when the business trust pays out 70% or so, depending on your contract, of your net profit to the personal trust as a lease payment, that turns active income into passive income, which can be deferred in your trust. And of course, we have a way of working with that other 30% that's active income that also goes. The business trust is a flow-through trust. It never pays taxes. It moves all the income into the personal trust. Personal trust can pay taxes. Hopefully, we can set up a system so that it pays very little in tax because it's deferred taxes. Okay. And then the private family foundation, what's interesting is that your personal trust or your business trust could donate 100% of their net income to the private family foundation and receive 100% tax deduction. So that 30% that's active income that goes into the personal trust, if you donated it to your family foundation would give you a tax receipt for that 30%, whatever it is, and then the personal trust would write that off, and basically that's the end of the taxation. And the private family foundation eliminates income tax. It has no capital gains tax. It has no property tax. It has no sales tax. It just doesn't pay any tax because it's a charity. The purpose of it is to do good work and help the community, and the government is supposed to do good work and help the community too. So the way that it supports the foundations and the charities is by making sure they don't have to pay any taxes. What's very cool, depending on how you set things up. So everything we're talking about now is generalities and let's just sort of say theory, because everyone's situation is totally different. How it all works would be totally different, and how the trusts and everything else are written up would be totally different. But the private family foundation, it spends 5% of its income or its assets, sorry, not its income, its assets. So if it had $100,000, say, and this is very simplistic. There's a complex calculation that needs to be made, but simply put, so we're not getting into it too deeply. If you had 100,000 in your foundation, 5,000 of it had to be spent on your good works. And if your good works is feeding inner city children in Chicago, then some of that money could go to, lunches and that sort of stuff to feed the kids. But some of it is also going to go to overhead. You may need to fly out to Chicago to see that the work is being done properly if you're not living in Chicago. So your flight and your accommodation and that sort of stuff would be paid for, and that sort of stuff. So it's 5% is your overhead, your administrative costs, and doing your good work. The rest of it is invested in something, which could be your business trust, right? So your business trust could borrow at rates set up by the IRS, money to further invest in your business, and then when that loan comes due, pay it back into the foundation. So those are the three foundations. In our future classes, we're going to talk about more about how they interact. And we did talk about some of the other benefits of having a trust, which are the privacy, asset protection, and legacy. So our trust is set up to last for generations, which means that you could have tax-deferred passive income growing your trust for hundreds and hundreds of years. Privacy, because unlike Bill and Melinda Gates, well, actually, Bill and Melinda Gates have their very public trusts and foundations, but they also have ones that aren't. And I talked about their son living in a trust-owned home in Chicago. The name of that trust had no Bill and Melinda Gates in it anywhere. It was like, how would you even know that this was part of their fortune? You wouldn't know. And that's the whole point of privacy. People don't know. And then asset protection. People, you can get sued, you can lose the case, and they're still not going to be able to get the money, right? It's one thing to win, it's another thing to collect. So I want to talk a little bit about the private family foundation. This is a specialized form of trust. It's quite a bit different than the business and IP trust, in that, as I said before, it eliminates taxes as opposed to deferring taxes. It's also very different because if you wanted to get a grant to do some good work, like let's say you wanted to feed inner city kids in Chicago, and you as an individual went to the mayor and said, "Hey, mayor, this is what I want to do." And he would say, "Oh, that's a really good idea, Scott. Yeah, come on. Well, let's keep in touch." And he would show me the door, and I would never get anything. And if I knew that they had a grant to feed inner city kids and I went and applied for it, I have a 1/70th of a chance of getting it compared to a foundation. When a foundation writes a grant and they apply to, whether it's a government grant or another foundation's grant, they're 70 times more likely to get it than an individual, because it's a different game, right? We're playing at this higher level. Like, you have a foundation, you know how things are, you know the rules, and you know how to do stuff too, by the way, that you don't know as an individual. So there's a lot of education that goes into being having your own foundation. Once you start realizing it, whoa, big difference. And so I like to talk about two quick examples of why a private family foundation is a must if you're getting your trust. It's probably a must even if you're not getting the trust, but Must if you are. First of all, if you have a business and you have a business trust and you get a family foundation, private family foundation, and you go to Google and you say, hey, this is my private family foundation. We're doing really good work feeding kids, but we'd really like to do some advertising on Google Ads. Can you help us? Yeah, sure. Here's $100,000 a month that you can spend on ads. And we don't really care what you spend the ads on. Oh, so I could spend some of them on, raising awareness of inner city kids, and I could spend some of them on my, let's just say, plumbing business. Yeah, for sure. But if you get a lead from the ads from the Private Family Foundation, you better make sure that you're paying for that lead, right? You don't want to be self-dealing or doing anything that's unethical. But the way that the Private Family Foundation can raise money is it can run these ads for you, and then you get the leads, you get the sales, you send some money over to the foundation. Cool. It's 10,000. Is it 100,000? $10,000 a month, $120,000 a year. Well, can I go to Facebook too? Yeah, Facebook will give you the same deal. Facebook and Instagram. You can advertise on them, $10,000 a month, thereabouts, right? And the way it works is they top up your Google Ads account. I think it's $384 or something. They've got it $384. If you spend all of it, they put another $384. If you spend $80, then they put $80 in. So it's not like it's not gonna grow. You have to spend it every day, right? But that's $100,000 from Google and $100,000 from Facebook just to do good work. Certainly more than pays for the cost of the Private Family Foundation and your trusts. The other thing is that you can use your foundation to work with other foundations. So, for example, there was a construction contractor, and he had a foundation. So he saw some land that had old houses on it. He thought, you know what, we could just drop these. We could just destroy these houses, build some new houses fairly inexpensively, and we would have low income housing. So he went to Home Depot and he said, this is what we want to do. And Home Depot said, great, we'll supply all of the material. And the guy goes, oh, great. So he goes to Walmart. This is what we want. Great. We'll supply all the, the beds and the utensils and everything you need to make the house look good. Oh, great. So for months and months and months, his team would, and then the foundation hired his company to build it, right? So the company would do all the work. They would build the foundation would pay the company, and everybody got great publicity, right? The mayor, would cut the ribbon and all the rest of it. And so his company got work, his foundation got tons and tons of donations. His team would go into Walmart and Home Depot every day and, with an empty truck and leave with a full truck. And they build these really good houses for these people that were on low income. And so it was a win for everybody. And especially, so you can use the foundation to support, or help your business in a number of different ways. So I just wanted to take a moment and tell you who your team is. Okay, obviously it takes a team of people to keep on top of all the tax laws and changes that occur. There's a change to the tax code pretty much every day. And also, like, who wants to look at all the laws and rules and regulations, make sure that everything that we're doing is right. And so we have lawyers. The founder that we work with is a retired lawyer, went to law school at Notre Dame. We have tax accountants, CPAs on the team to keep an eye on different things, make sure everything is done correctly, and enrolled agents. And those are the people you probably have not heard of. So they're the people that if you have to go in front of the IRS to defend your income tax because they think you did something wrong and they're after you, an enrolled agent is basically your lawyer. They've done a Department of Treasury courses, and they've got like 80% or something on them. And one of the cool things about enrolled agents is you can take your trust to them, give it to one of them, and say, is this right? Like, I don't want 20 years from now to have this massive tax bill because they say, no, none of this stuff was right. It's all done wrong. And they will write a letter saying, if they agree, yeah, this is Scott's trust is done in good faith and it looks good to me and I think it's fine, blah, blah, blah. So then 10 years go by and the IRS knocks on your door and says, no, like this trust thing you've got's no good. So you hold out this letter, you show it to them, and they'll say, okay, you still owe your back taxes, but we're not going to put you in jail and we're not going to charge you any late fees and we're not going to charge you any interest because an enrolled agent said this thing was okay. And of course you should trust them. So we're going to, look after that. The lawyer that does this has $1 million errors and omission insurance. And so she'll pay for all your back taxes. So this is all about mitigating risk when it comes to asset protection. And we also want to mitigate risk when it comes to, will this thing really work if you get audited? And so far, we've had one audit out of hundreds, if not thousands of trusts, and it went swimmingly, no problem, because we're working at everything and looking at everything as if we're going to get audited. So we ask those questions and we make sure that if anything happens, you're as protected can be. And finally, one size did not fit all. So this has been pretty much an overview. And if this is something you're really interested in, then contact me and we need to have a meeting and talk about your specifics. In the following parts of the course, I'm going to get into, what the trusts, not what they look like, but some of the strategies that you can use it and how you can use the trust, how they're set up, who's the grantor, who's the trustee, who are the beneficiaries, that sort of thing. Get into some of the details, but I felt like this has been an hour just to kind of give you the overview, and hopefully you find it helpful.